Welcome to the daily update, where I'll go over the action in the market for Thursday, May 2nd, and then we'll see how things look for Friday, May 3rd. Had an up day, showing a little bit of improvement in the charts. However, until we break above the 20 period and 50 period moving averages as far as overhead resistance, we're just range bound for right now. So yeah, we're shifting back and looking a little bit better there, but it's really not going to matter. So we'll see. We have the major employment report coming out in Friday's session. We'll see how the market reacts to that. If it treats it more as friendly, are we going to break out to the upside? If it's more negative, are we going to break to the downside? We are still negative, both in the short and intermediate term, but the long term is still positive. We need to break out of this range to have everything shift back more positive. So let's go back and talk about what happened, and then I'll go through the charts. Right at the open, we did have a higher open. The futures were doing fairly well before the open, but then right after we opened, we saw selling that took place, and we fell below the daily pivot at 5,043. We also fell below the unchanged level. As the day went on, we tried to match the previous day's low, and we kind of overdid it just a little bit as we were filling the gap. But then we chopped back, and it wasn't straight up. We just kind of worked our way higher back to the unchanged level. And then we finally broke out later in the day. We hit resistance at R1 at 5,072, and then we just closed slightly below R1. So we were up 0.93%, not a huge move, but we were able to recoup some of the losses that we've seen. And we were still above average with volume. And as I said, we're negative short and intermediate term. Long term, we're positive, with a lot of our indicators kind of giving mixed signals, but we're still leaning more negative. And we've been dealing with this inflation and interest rate situation. And then on top of that is the employment situation, and we'll see how that feeds into this whole thing. We want to keep an eye on all the different geopolitical events. Specifically, oil just keeps dropping. So things seem to be a little bit calmer as they apply to oil, and then as that applies to the markets. Of course, now all the real buzz is going on about the protests on college campuses. But again, that really doesn't have an impact on the stock market itself. Some comments. The markets are embracing the idea that the Fed is unlikely to raise rates again. Now, they've been anticipating cutting rates, but now they're saying, well, okay, we may not get that, but we're going to shift over and say it looks like they're probably not going to raise rates. The mega caps and the semis, they had a pretty good day, but they're still range bound as well. On a short-term basis, our slope oscillator, it's still above its moving average. It's still giving us an extreme negative reading, but it is showing some improvement. On a long-term basis, with the up day, we saw our 150 and 200 period moving averages kick back up slightly. And I reworked this just a little bit, that the Fed will likely leave rates unchanged. Okay? They're not going to raise them, but they're not necessarily looking at lowering them, because this inflation that they've been trying to get back down to 2%, that's really stubborn right now. They call it sticky inflation. But the timeline is more uncertain, where they had figured 6 to 7 rate cuts at the beginning of 2024, then that got whittled down to 3. Now it's kind of really uncertain as to when those rate cuts are going to happen, if they're even going to happen at all. The dollar was down and interest rates were lower. This did give some support to stocks. We closed at 4.57 with the 10-year yield, where we had been at 4.6%. We're still inverted with the yield curves, and this is kind of crazy with the sentiment. When I go to CNN Money to look this up, I actually had us at 41 yesterday and then at 36 right now. On an update, to have that go down 5 points is really strange. So kind of take this with a little bit of suspicion right now. But the latest reading is 36, and then it was unchanged from 36. That's still negative. And our trend is still negative as well. We're still below the moving average. And so that suggests a weakening trend, but we're still above 20. So it is a trending environment. However, the red line is still on top. So it's a weakening negative trend. With the up day, our bias is positive. And now, instead of being mixed to negative with momentum, since we had a fairly good up day and we're more range bound, I've just switched that back to mixed. The economic reports that came out, we had a pretty long list. We had weekly jobless claims come in at 208,000. They expected 213,000, so that was less than expected. Last week, we did see 208,000. So now instead of that 212 level that seemed like we were getting, now maybe 2008, 208,000 is now the magic number. The continuing claims pretty much came in as they were last time at 1.774 million. The trade balance was negative, as it always is, and not too much more than the minus 69 billion they had expected, and right around what we saw last time. And this was a little bit bigger. The first quarter productivity, it came in up 0.3%, which was less than expected. That's not inflationary. They expected it to be up 0.8%. Last time it was up 3.5%. So that was quite a drop off there. The unit labor cost, this is also more inflationary. What you want to have is pay from a stock market shareholder perspective, or even from a company standpoint, is you want to pay your people less and have them do more. When you have to pay them more and see them do less, that can be not as efficient and also more inflationary. Where the unit labor costs, the preliminary reading came in at 4.7%, a lot higher than the 2.5%. So that is a lot stronger, where last time it was unchanged. Factory orders were at 1.6% as expected, and up from the 1.2% we saw last time. So here's some charts. Here are the weekly jobless claims. We're kind of heading down to this 208,000 level. The moving average is coming down. So this is suggesting that employment is still strong, and that just is suggesting also that the economy is still continuing to hold up. What we're waiting to see is when employment really starts to fall apart and then the yield curves go back to being normal, that's when we start really counting down to see if we're going to go into a recession. But as long as the employment situation is remaining solid, the economy, even though people are having their struggles, and there's the Wall Street economy and then there's real life economy, and the two are often completely opposed to each other. But these numbers, and we know they're manipulated, we know they're baked, we know, but this is what the market uses to make decisions, so we go with it also. But as long as this holds up, things are still looking okay. But we're going to get the updated unemployment rate in Friday's session. The continuing claims are also coming down, showing some more strength here, and the moving average is also declining. So here is everything together, where we have the red line, or the initial claims, which have been declining. Continuous claims been going sideways, but down a little bit. And then we'll get the unemployment rate on Friday. Here's a bigger blow up of that same thing to make it a little easier to see. So here's the monthly nominal trade balance, where it is going down. Not a real surprise. We're seeing more that's actually coming in rather than what's going out. And this is a 3-month average. And then exports and imports, where we're actually going down a little bit with exports and up a little bit with imports. Again, not really surprising there. And here's the deficit, just showing, and it's usually that way. 70 years ago, we were a company that exported to the rest of the world. Now we import from the rest of the world. And then non-farm productivity and unit labor costs, where we're seeing productivity going up, which on a year-over-year basis, okay, that's okay. And on a cost basis, that's actually coming down. So this is more friendly on a year-over-year basis, even though the month-over-month report we had was a little bit scary. Factory orders were up just a little bit. We're a little bit above zero right now on a year-over-year basis, and durable goods orders are declining and actually below zero. Non-durable goods are above zero and going up. And the non-defense capital goods, year over year, we are declining and now going slightly negative. And then here's some charts. This is actually kind of an interesting chart. I wish I could replicate this somehow, but I don't have access to the data that lets us do this. This is the forward earnings per share year over year percent change, which we do that more on a weekly basis, which is based on daily charts. I could also get up a weekly chart. It'd be nice if we could get a year over year type of a chart. But if you look at the times when projecting forward and you look at earnings and it's positive, that's when the market goes up. When this starts to decline, that's when we see some problems. we were going up here and then it started to trail off and then we went into 2022 and now this is starting to show some improvement. So this is looking more positive going forward. Then we look at the US heavy truck sales. They're going back up a little bit. Again, that's a sign of a fairly strong economy. And then considering strong first quarter earnings and in line with Deutsche Bank's upgraded whatever a house macro forecast is, they're raising their earnings per share for 2024. It had been $250 for their based around the S&P 500. They raised it to $258. So they're seeing things a little more positive on an earnings basis. And then the aggregate, taking all together, the margin, this is operating margin for the S&P 500, it's rising. So companies are spending more money. They're doing more that can help the economy in the way that they operate. And this is going up, and that's looking fairly positive there. But this is, we're seeing a real drop in the U.S. savings rate. It's at 3.6%, where the average is at about 9%. And this is where you deal with the real economy that we have to go through day in and day out, where folks, of course, they got the stimulus checks and we're saving a lot of money, and that has really dropped now. And that is just showing the stress that we see on a lot of us that are trying to live day in and day out lives. And then we have the manufacturing index. Now in Friday, we're going to get the non-manufacturing or the services ISM, where the S&P has been coming down. That's the purple line. And we also declined lately with the manufacturing index here. And then I did find a couple interesting charts. We are keeping an eye on the banks, and for decades, I watched CNBC. It was the first thing I would turn on in the morning, and the last thing I turned off. Well, I'd watch The Simpsons, okay, just to kind of relax. But I don't even pay attention to it now. It's 99. Even when I watched it all the time, 99% of everything was pretty much useless, and then it became so combative politically. It's like, I don't care about that. Just tell me what's going on in the markets. I would actually find myself watching the international versions of CNBC because they would bring in technical analysis. They were talking to different people that actually had something interesting to say, where it's not that much in the US version of CNBC. But I have found some use in their website. They do have some pretty decent articles from time to time. And here's one that was posted: why hundreds of US banks may be at risk of failure. And we've been watching that. And especially with a lot of these banks pretty much figuring in that the Fed was going to cut rates in 2024. If that ends up not happening, this was part of the plan, especially with these smaller banks. What's that going to do to them? Are we going to see some more bank failures coming? Now, that happened, well, about a year ago with Silicon Valley Bank and Republic Bank, and then a few months ago with New York Community Bank. We're just kind of waiting to see if something else is going to develop with these other banks. Then I thought this was kind of interesting. Nobody wanted to buy Bitcoin when it was at 50,000, but now if it's getting up close to 100,000, the whole line is there. It's just kind of, this is crowd psychology here, where people tend to do the wrong things at the wrong time when it comes to investing and being in the markets. And then this is kind of interesting, where how many rate cuts they're still expecting. Citigroup, they're still expecting 4 rate cuts. Okay, the Fed's going to really have to get on the stick. They've only got, 3 meetings left? That means they'd have to, maybe 4 I'm not sure the actual number, but they're going to have to get going here, where Morgan Stanley thinks there's going to be 3, Goldman Sachs, Nomura, and Evercore at 2, and then everybody else thinks there's going to be 1. But the takeaway from this is they're still expecting rate cuts, but it's just Citigroup. I don't know, maybe they didn't get on there to update their number or something. I just thought that was interesting. Not sure where we're all with in this whole cycle thing. I'm not sure if there's anything to it. It did look like we were kind of following this in April. Maybe we're in this choppy phase now that we're getting into May. So here's our intraday chart, where we did have a higher open and we kind of spiked up, and it looked like, okay, at least the open's going to be positive. But then we immediately saw some selling into that. We went below the daily pivot. We came down, actually went negative to match Wednesday's low to kind of test that. And then we chopped our way back up to the daily pivot and then chopped underneath. And then it was later in the day when we were able to break above the daily pivot. We got up to R1, stalled out right there, and then closed just a little bit below R1. Here's our intraday chart. We're up a little bit, but a lot of it's really going to hinge on the employment situation report, which will be coming out an hour before the stock market opens. So I don't really pay attention to the futures before this report comes out because it's so influential. Let's hope it's influential. The difficult part will be if we see mixed signals within the report and it leaves the market more confused. And we're looking at growth of value here. We are just underperforming on an intraday basis when we look at the blue line and the red line. So growth is underperforming a little bit. On an intraday basis, we did see some improvement here, but we're now kind of more range bound after we had been trying to tick back up intraday with S&P growth of value. Our end of day charts, growth was up more than value. It was up a little bit more with the mid caps and up less with the small caps. So we ticked back up with small cap growth of value, a little bit of a tick up with the mid cap growth of value, and just barely a tick up with S&P growth of value. Looking at these ETFs that we follow, we're bouncing back up a little bit more into the rainbow. So we're just keeping an eye on this to see if it can get back up and get above the rainbow, or if it's going to drop down below the rainbow at some point. Discretionary to staples, the ratio actually ticked down just a little bit, but we're still bouncing off of this 200-day moving average. And we're range bound here. This is a really good example of that, where we have the 50-period moving average above current prices. We have the 100-period moving average below current prices, and we're stuck in the middle with you, like the old song says. Clowns to the left of me, jokers to the right. Okay, Wilshire, we're still below the 50-day moving average. This is a broad market measure. And we're still negative here. The ADX is not really showing any kind of conviction right now. It's still kind of right on top of its moving average, but the red line's on top, so we still are negative there. We're also negative here, maybe turning up just a little bit with the ADX, but the red line is still on top. Volume did pick up. We've been seeing some above average volume, so that's at least encouraging from that standpoint. And we're more neutral in the latest reading from Investors Intelligence. We're coming down and actually now starting to drop below the moving average with the Ulcer Index as fear has been subsiding lately. And we dropped with the VIX. We're coming down. We closed just a little bit below the moving averages. Also with the bar chart, spent most of the day around the moving averages there. And I guess this is not erroneous data after all. There was some real big spike in the VIX of the VIX. But with the up day, we did decline with the bar chart and the line chart, and we're getting down to kind of a low reading now that can sometimes suggest volatility is not picking up and there's really some complacency in the market, where the momentum of the VIX continues to be down, and that's more positive for stocks. We're turning down now with the equity put call ratio. We saw it really spike up. I couldn't update this in yesterday's video. That really picked up, but we saw some decrease in the daily chart, but we're starting to go back up again now with our 5-period. So that's more negative for the market. We had the latest reading of the American Association of Individual Investors, a bit of a tick up. Now, this is about a week old now. So where we had dropped slightly negative, now we're going up and looking slightly positive. And the volatility risk premium, we're still below the lower band. It's really not bouncing around the way some of our other charts have been lately. We decreased with this fear gauge, but we actually increased with this other fear gauge that we follow here. Advanced decline lines, a bit of a tick up based on price and volume. We'll have to see. We're not seeing any conviction as we're chopping more or less sideways right now. This is still more positive. Even though we're seeing a bit of a decrease in the new highs, we're not seeing an expansion of the new lows. So the raw score itself is still holding up. It would be nice if we could have broken out on an up day, but we're right back to prices where we've been before, so there really wasn't the opportunity for new highs to be created. We're going up with the 5-period and the 10-period. We're crossing slightly back above zero with the advanced decline ratio, so that's kicking a little more positive. We saw a little bit of an improvement with the accumulation distribution, but we're still below the moving average. And the chicken money flows ticking back up again, but it's still negative. Chaikin oscillator ticked up just a little bit. You can barely see that, but it is now negative. And we did see a move up with the cumulative NYSE advanced decline line and a little bit of an improvement with our regular NYSE advanced decline line and a little bit of an improvement with this other NYSE advanced decline line. Looking at common stock with the advanced decline line, a little bit of a tick up here, a little bit of a tick up with the volume as well. We're going back and looking a little more positive with the NYSE new highs minus the new lows. We're still above zero with the raw score. And when we look at S&P, the cumulative advanced decline line based on price, it actually came down just a little bit. Is that right? No, it ticked up, but you can barely see it here. And it ticked up just a little bit based on volume. And we're getting a little bit above the moving average with our NYSE common stock. When we look at all of our advanced decline line studies, coming up to the moving average with the S&P, a little bit above with the mid caps, and just peaking out a little bit above its moving average with the small caps. So here's our daily chart where you can see this blue line here. That's the 50-day moving average, and this is acting as overhead resistance, as is the 20, depending on where we're at with things. We're going to have a really difficult time until we can get above this pivot point and eventually close above the 50-day moving average. Or if we fall, that's going to turn things decidedly more negative. And here's the 20-period moving averages. You can see as they've been coming down, these have been providing, at least over the last few days, a series of lower highs and even lower lows. We were looking a little better where we were seeing higher highs and higher lows. Well, we hit this moving average area and we've been coming back down, even though we had an up day on Thursday. Here's our 20-period moving average based with, okay, let me back up. Here's our double and triple exponential moving average based on 20 periods, kind of chopping sideways. We're right in between both of the lines here. And this is still acting as overhead resistance with our 20-period simple moving average of the open, high, low, close. The mini rainbow might look nice, but it's providing resistance. We ticked up a little bit with the 20, 50, and barely a bit higher with the 200-day exponential moving average study. A little bit of an improvement with the force index, but still negative. Turning back up, looking a little positive in the short term, still declining in the intermediate short term, still rolling over in the long short term stochastic. And we're just a little bit under the midpoint now with our standard deviations chart. Intermediate term, we ticked up, but we're still negative with the balance of power. Still seeing the deeper purple with the go, no-go system. That's negative. Still below the midpoint with our highest high, lowest low values chart. Seeing a continuation of a bit of an improvement here with the TTM squeeze. It's a lighter shade of red, and they are coming back up more to the midpoint. And we're still below the double and triple exponential moving average based on 50 periods. This is still providing overhead resistance. And here's our 50-period moving averages, where we came right up to the exponential moving average. That was pretty much the high on Thursday. And then even though we came down and we ended up having an up day, these moving averages are also providing overhead resistance. If the market really likes the report that comes out and we scream to the upside, we're going to want to get above this simple moving average based on 50 periods. And right now that's at about the 51.29 level. If we see the market really going down and with any velocity to it, we're still watching the 100-period moving averages as support. We're still negative with the ease of movement, even though it ticked up. The Erin has kind of gone to sleep right now. We're just barely above zero with the S&P McClellan oscillator. So we're still kind of flattening out based on price, and we're still declining based on volume, even though I guess it ticked up just a little bit. These bumpy days make these charts kind of hard to pick out what's going on. We're a little more positive in the broad market with the NYSE McClellan oscillator. It's further above zero. So we're just chopping around and looking a little bit better with the summation index based on price and volume. And this was a warning sign that I brought out in yesterday's video where we dropped below zero with the Swenlin trading oscillator based on price and volume. We're coming right back up to zero. In fact, we're just fractionally positive, but we're still negative based on volume. Our momentum still is not really showing much improvement. The PMO is going down, but when we break it out based on price, we're looking a little better, but volume is now going sideways. So we saw a little bit of a tick up with the PMOs that are rising. We're flat with the buy signals, and we're flat to declining with the PMOs above zero. We switched from being negative back over to neutral for the Elders Impulse system for the S&P. We're still positive with the parabolic SAR. Here's our slope oscillator, our touchiest oscillator. So we watch this a little closer. We're negative, and we're still extreme negative, but we're above the moving average, and it's starting to go back up. The MACD is right on top of its moving average again. So that's still negative because we're below zero, and we're not really breaking out above the moving average. So in the short term, our slope oscillator, it's the one looking a little more positive, where our other short term one, the TSI, it's now going sideways. We're still seeing weakness with the MACD, the PMO, and the PPO, and we're still negative with the TRIX and the KST. And we're right in the middle of all this spaghetti mess in moving average land. And this ticked up just a little bit, but again, to have an up day and to see the bullish percent index not really move is not really encouraging. However, we're still above 50, so it is positive. We ticked down just a little bit with the NYSE bullish percent index, and we're flat to slightly declining with the NASDAQ 100 bullish percent index, and we're below 50, so this is still negative. The money flow ticked up, but it's still below 50. That's negative. We ticked up with the ultimate oscillator, but below 50, negative. Negative with the vortex with the red line on top. We're showing some improvement with the RSIs, but we're still below 50, both with the 14 and 9 period. We're still below a declining moving average with on-balance volume. When we look at the stocks inside the S&P and their 20 period moving averages, we did tick up, but we're still below 50. We ticked up with the 50 period moving averages, but still below 50. We ticked back up and we're slightly above the midpoint or above 50 based on 100 periods. And we turned up a little bit with the 200 period moving average study. The copied curve is looking a little bit more positive. The Sean trend meter ticked up, but has not been real convicted lately. We're still trailing along the lower end of this Ichimoku cloud. As it's been going up, this has been providing a level of support. And the Pring bottom fisher is now generating a buy signal. Not really going to mean much unless we can break out above the 50-day moving average based on price. And the mass index still kind of kicking into gear here. We crossed above the red dash line. We're coming closer to the blue line. When we go above it and turn and come down and then go below the red dash line, this indicator is anticipating a switch in trend at that time. Our different charts, we're still negative with the Heiken Ashi. We're positive but pointing down with the Kegi. We're negative with the Renko and negative with the 3-line break. And we're still below this R1 level on the weekly chart of the S&P. We'll see if the market has a chance to even test that again. And we're coming down we were up in the session with the 200, but we declined just a little bit with the 150, but we're still looking barely extreme positive. And we're seeing a little bit of improvement in the short term where the small caps had a pretty good day. So they've gone back to positive in the short term where the other indexes are still negative. So we're negative in the short term with stocks, bonds, commodities, and the dollar. We're negative with bonds based on price. No changes in the decision point scorecard. Saw a few blues, a few reds here. Things were happening, but nothing that applies to the S&P. And the equal weight was up with the S&P 500 as well, but we show here that the mega caps outperformed and the semiconductors. So, but this has been chopping sideways. We're not seeing any real conviction right now. It's just kind of blah, blah, blah sideways. And we saw a bit of a tick up, but we're going up into the middle part of the range with the Dow. But we switched over to positive with the Elders Impulse system for the diamonds. We came back up to this pivot point with the NASDAQ. We came back up to this pivot point with the NASDAQ 100. We switched from being negative over to neutral with the QQQs. The momentum trying to show some improvement here, but still negative until we see it a little more clear. And we're still looking a little more negative with the QQQs. We did see the 20 cross below the 50, and these moving averages are providing overhead resistance, but the longer term trend is still positive. And small caps were up, but just right back to where they've been before. And we switched over to positive with the small caps with the Elders Impulse system. We were able to bounce up above this resistance / support level, but who knows? We might have a down day and come right back down to it. The mid caps also coming right up to this pivot point and not able to close above that. but they've switched over to positive with the Elder's Impulse system. Apple is still in a downtrend, even though it was up over 2%. It's coming back up to its 50-day moving average. Tesla was virtually unchanged after we saw the spike up, and then it's been coming down, and it's pretty much on its 50-day moving average, but still in a downtrend. Nvidia still battling around its 50-day moving average. It was up 3.33%. Microsoft ended up being up almost 0.75%, but it's still well below its 50-day moving average. Meta, which is pretty much chopping sideways now after really gapping lower, it was up a little over 0.5%. And Amazon, which had reported earnings, it was up over 3% and starting to climb above its 50-day moving average. Google, after spiking up and then coming back down, it was up about 1.88%. The FANG index is still under its 50-day moving average. The financial sector was up, but we're still a little bit under the 50-day moving average. And we came back up here a little bit with the staples. We're coming back up to this longer term moving average. We want to see if this is going to provide overhead resistance here. It would be more beneficial if this would turn and then start to go down. That would help support stocks going higher. The dollar ended up declining, which gave support to stocks. Looking internationally, the short-term relationship is getting stronger. We're still pretty much flat to slightly declining with the longer-term relationship. We're still below the 50-day moving average with our total U.S. stock ETF. We were down with the 10-year yield. We were up with the 10-year based on price. And we're seeing not really an improvement here with the Qs to S&P. It's dropping below its moving average. Discretionary is flat, slightly above the moving average, but the moving average is still declining. Didn't see much of an improvement with large cap growth versus large cap value. So not much of an improvement with the large caps, still under the moving average with the mid caps, and also under the moving average with the small caps. Still looking okay and showing some improvement here with our 10-day average of the S&P 500 highs minus the lows. We're above 50 and showing a bit of a bounce here. And we're seeing a little bit of an improvement with our 19-day exponential moving average of the advanced decline ratio. We crossed back above zero based on price and volume. And our broad market measure of the 5-period moving averages of the highs minus the lows, just barely positive now, where it had slipped to more negative. This is still going down and kind of a concern. The S&P is underperforming utilities right now. It would be more positive if this ratio was going up. And we're kind of chopping around with our staples S&P 500 ratio. It would also help if this ratio was going down. And we have 1 day left here to see if we're going to get a ZWAG NYSE breadth thrust. But it's going to have to be one monster of a day for that to happen. So what's our outlook for Friday? In the short and intermediate term, we're still negative and we're still below overhead resistance. We're going to get the employment situation report, the S&P services PMI, and the other big one is going to be the ISM non-manufacturing PMI. Want to keep an eye on the geopolitical events. We'll finish out the economic calendar. Here are the big things and what we saw previously and what some of the forecasts are as far as the employment situation. Seasonally, we're neutral to negative across the board with the Dow, S&P, and NASDAQ. May to October, according to this Carson report, shows that that's the worst 6 months. And we do see some negative seasonality here, going down with the green dash line on the 3rd trading day of the month during an election year. Friday is one of the more positive days of the week, and we're still below the average of what usually happens during an election year. We'll see if that can improve or if it's going to even get worse. Also below the average according to the Stock Traders Almanac chart. And then we do see more of a trailing off in May before we see some strength going into June, July, and August. And the first part of May is typically more negative. Now, these longer term charts, I'm probably going to shift them over to the weekly video after this video because they're longer term and you don't necessarily need to see them every day. But Carson, according to this study, going from 1950 to the present, broken down by presidential cycle, they have us up 77.8% of the time with a 2.3% return. And then, as I've been saying also, this will probably go over to the weekly chart as well. We do have a pretty good track record in May, but the returns are not very good. And here, this will also get switched over. Looking over the last 10 years, where we're up 90% of the time in May, with the median return at 1.1%, but the average is 0.7%. But this is just going back. Now, yeah, it's more closer to right now, but it's not necessarily what we've seen on a more historical basis. And then where we do see June, July, and August, which are tending to be more positive during election years. And this probably will get over to the weekly. I may even stop using this one. The green line, it just means that's when we're in a bull market. The red line is a bear market, and then all the years together. And you can kind of pick out where we're at right now. And since we've had a solid month, even in May, when we're in a bull market, we do see some trailing off during the month of May right now. So our warning signs: the equity put call ratio based on 5 periods is now going back up. The bullish percent index for the NASDAQ 100 is negative. The Swenlin trading oscillator is negative. The Chaikin money flow, the Chaikin oscillator, the money flow, the ultimate oscillator, the Copic curve, the vortex, and our oscillators, those are all negative. We're still below short, intermediate, and long term. I'm calling this resistance now to see if we can actually get up to it and test it, where I had been calling it more support. And the momentum for the NASDAQ 100 is still negative. It's trying to improve, but not quite there yet. On the positive side, we've gone back to being positive with the McClellan oscillators for the S&P and NYSE. The parabolic SAR is positive. We're still above 50 with the bullish percent index, and the long-term trend is still positive. The financial sector is still hanging in there for right now. And we have 1 day left to see if we're going to get a new ZWAG NYSE breadth thrust. So our conclusion: we're negative in the short and intermediate term, and we're below overhead resistance. That's what we're dealing with in the short term. That's also what we're dealing with in the intermediate term. In the long term, we still continue to be positive. So thank you. I really hope you found this helpful. It should be an eventful day. Let's hope some things become a little more clear in Friday's session. I hope you do have a very good day, and I will talk to you in the next video.